Three friends invest the same $1,200 a month. One trades all day. One trades every few weeks. One buys one boring fund. 30 years later, the hardest worker finishes almost $916,000 behind the man who barely opened the app. And the reason has almost nothing to do with intelligence. Before we run the numbers, subscribe to the channel and hit the like button. Because this video is not about telling you that trading is impossible. It is about showing you the full scoreboard. Not just the winning screenshots, not just the exciting months, the taxes, the hidden costs, the time, the missed compounding, and the final amount of money each strategy actually produces.
Meet Noah, Cameron, and Miles. They are all 31 years old. They each earn $82,000 a year. They live in the same city, fall into similar tax brackets, and have the same goal: build enough wealth to have real freedom by age 61. Each man invests exactly $1,200 every month for 30 years. That is $14,400 a year and a total personal contribution of $432,000 by the end. Same age, same salary, same contribution, same timeline. The only difference is what happens after the money enters the brokerage account. Noah becomes a day trader. He wakes up early, reads the pre-market news, studies volume, watches price levels, and waits for the opening bell. He trades breakouts, he trades reversals, he trades earnings announcements. Sometimes he is in a position for 2 hours, sometimes for 6 minutes. His goal is simple: take small profits from the market again and again until those small wins become serious wealth. Cameron chooses swing trading. He has no interest in staring at 5 monitors all day. Instead, he looks for stocks moving in a clear direction. He buys on Monday and might sell on Friday. Sometimes he holds for 3 weeks. He checks charts after work, adjusts stop losses, reads company news, and moves from one opportunity to the next. Then there is Miles. Miles buys one low-cost total market index fund every month. He does not choose individual companies. He does not predict interest rate decisions. He does not study candlesticks. He does not ask whether the market is about to rise or fall. His contribution happens automatically. The money enters the account, the fund gets purchased. Miles goes back to his life. At first, his strategy does not look intelligent. It looks lazy. During the first year, Noah has the best stories. He makes $1,400 in a single morning after correctly trading a technology stock. He makes another $900 during a major earnings announcement. He sends screenshots to the group chat. He starts using phrases like, "I caught the move," "The setup was perfect," "I knew buyers were coming in." And sometimes he really is right. That is important. Noah is not losing every trade. He is not stupid. He is not randomly pressing buttons. He studies, he keeps notes, he follows rules, and during a good month, his account can move much faster than Miles' boring index fund. Cameron also has exciting moments. He buys a stock before a strong 3-week rally and earns 11%. He exits another trade one day before bad news sends the price down. At dinner, Cameron and Noah can talk about the market for hours. Miles has almost nothing to contribute. What did you buy this month? The same index fund. What do you think happens next? I have no idea. That answer does not impress anyone. Nobody posts a screenshot of an automatic index fund purchase. Nobody celebrates a 0.7% monthly move. And nobody sells a $2,000 trading course called Buy the Whole Market and Go Outside. Activity looks like expertise. Patience looks like ignorance. That's why the scoreboard is so easy to misunderstand. In year 3, Noah has an incredible run. The market is moving quickly. His strategy works. Several trades deliver large gains within a few weeks. He finishes the year far ahead of Cameron and Miles. For the first time, Noah starts thinking about quitting his job. He calculates how much he could make with a larger account. If he can earn this much with his current portfolio, imagine what happens when he has $200,000 or $500,000.
He is no longer thinking like an employee who trades. He is thinking like a future professional trader. Then April arrives, and Noah learns that profit on a screen and wealth in your life are not the same thing. Because Noah sold almost every profitable position within a year, most of his net gains are short-term gains. They do not receive the same treatment as investments held for longer periods. They are generally taxed like ordinary income. The government does not care that Noah plans to reinvest the money. The tax is due because the gain was realized. Some of the capital that could have remained in his account and compounded for decades is now leaving the account permanently. Then the strategy cools. A pattern that worked 6 months earlier stops working. 2 large losing trades erase several smaller wins. Noah gives back part of his great year, but the tax bill from the realized profits does not disappear just because the next trades went badly. This is where the emotional scoreboard begins separating from the financial scoreboard. Noah remembers the great trades. His account remembers every trade. To understand Noah's outcome, imagine that every dollar he earns must pass through 3 toll booths. The first toll is taxes. The second toll is trading friction. The third toll is human behavior. Let's start with taxes. A long-term investor can delay selling for years or even decades. That does not make the future tax disappear, but it allows more of the money to remain invested in the meantime. Noah is constantly realizing gains. Every successful exit can create a current year tax event. The second toll is friction. Many trading platforms advertise zero commissions, but zero commission does not mean zero cost. There is still a difference between the price buyers offer and the price sellers request. There can be slippage between the expected price and the executed price. There may be options costs, data subscriptions, borrowing costs, or unfavorable fills during volatile moments. A few dollars on one trade feels meaningless, but Noah is not making one trade. He is making hundreds. Small leaks become serious when they repeat for 30 years. And then comes the third toll, Noah himself. Noah feels pain when he sells a position for a loss, so sometimes he waits. He tells himself the stock will recover, but when a trade becomes profitable, he becomes afraid of losing the gain, so he closes the winner quickly. The losing positions receive patience, the winning positions receive fear. And even when Noah knows this behavior is dangerous, knowledge does not automatically remove emotion. This is not an argument that no day trader has skill. A small number of traders do appear to earn persistent profits. Some have superior tools, some have specialized knowledge, some have strong risk management. Some operate in very narrow areas of the market where they have a genuine advantage. Those people exist, but they are rare. One major study followed people who continued day trading equity futures for more than 300 days. 97% lost money after costs. Only a very small fraction earned an amount comparable to a normal salary. Another well-known study examined more than 66,000 brokerage households. The households that traded the most earned dramatically lower returns than the market during the study period. That does not prove that Noah must fail. It proves that Noah is entering a competition in which confidence is common and persistent success is not. So, to keep this comparison fair, we're going to be generous to him. We will not assume Noah loses everything. We will assume he is more disciplined and more successful than the typical unsuccessful trader. After taxes, trading friction, mistakes, and good years mixed with bad ones, we'll give Noah a net annual return of 4%. That is not a prediction. It's a favorable hypothetical outcome designed to test whether a profitable day trader necessarily becomes the wealthiest investor. Cameron believes he has avoided Noah's biggest mistakes. He does not trade every hour. He does not react to every small price movement. He gives trades time to develop, and he makes far fewer transactions. That helps. His trading costs are lower. His decisions are less frantic. He has more time to research a company before buying it, and he can keep a full-time job without watching every market movement. But calmer does not automatically mean passive. Cameron is still making 2 decisions that are extremely difficult to repeat successfully.
when to enter and when to leave. Buying a good company is not enough. Cameron must buy before enough other investors recognize the opportunity. Then he must sell before the trend reverses. If he sells too early, he misses much of the gain. If he sells too late, the gain disappears. And because most of his positions last weeks or months rather than years, many profitable sales still create short-term tax consequences. Cameron pays fewer tolls than Noah, but he still uses the same road. For our comparison, we will give Cameron a 6% annual net return after taxes, costs, winning periods, and losing periods. Again, that's a respectable result. Cameron is not failing, his money is growing. The question is, what happens when respectable growth competes against decades of uninterrupted compounding? Miles does not know which company will dominate the next decade. He doesn't need to know. His fund owns a broad collection of companies. Some will disappoint, some may disappear. Others will grow far beyond what investors currently expect. The fund automatically gives more weight to the companies that become more valuable and less weight to those that decline. Miles is not betting that every company wins. He is betting that productive businesses, as a group, continue creating value over long periods. His advantage comes from what he avoids. He avoids constantly moving money. He avoids trying to identify every market top. He avoids creating a new tax decision every week. He avoids allowing one bad stock selection to destroy the entire plan.
And because his fund is inexpensive, more of the market's return remains inside his account. For this hypothetical scenario, we will assume the index fund compounds at 8.5% annually after normal ongoing fund costs and routine tax drag, but before the final sale. At the end, we will apply a simplified 15% federal long-term capital gains tax to the accumulated appreciation. We are not including state taxes. We are not adjusting the results for inflation. And 8.5% is not a guaranteed future return. This is a model. But all three men will be judged by the same contribution schedule in the same 30-year period. Now we can finally watch the separation happen. After 5 years, each man has personally contributed $72,000. Noah, earning 4%, has approximately $79,600. Cameron, earning 6%, has around $83,700. Miles has an after-tax equivalent value of roughly $86,700. The difference between first and last is only about $7,000. Noah is not worried. One good month could close that gap. At this stage, effort still feels more important than structure, and that is why so many people continue. 5 years is long enough to feel experienced, but it is not long enough for compounding to expose the full cost. After 10 years, each man has contributed $144,000. Noah has approximately $176,700. Cameron has around $196,700. Miles has roughly $213,500 after the simplified future capital gains adjustment. Miles is now almost $37,000 ahead of Noah. But Noah does not experience the loss as a $37,000 event. There is no mourning when his account suddenly falls behind by $37,000. The difference accumulates quietly. A little tax here, a poor exit there, a few dollars of slippage, a month when Noah sits in cash because he expects the market to fall, another month when he increases risk after a winning streak. Nothing looks fatal. That is what makes the damage powerful. After 15 years, total contributions reach $216,000 each. Noah has about $295,000. Cameron has approximately $349,000. Miles has crossed $401,000. The gap between Miles and Noah is now more than $106,000. That is no longer one great trade. That could be several years of mortgage payments, a college fund,
a major part of retirement, or years of freedom later in life. Noah is still profitable, but profitability is not the correct benchmark. The correct question is, did all the extra decisions create more wealth than the simple alternative?
At year 20, each man has invested $288,000 of his own money. Noah has around $440,000. Cameron has approximately $554,000. Miles has crossed $683,000 after the same simplified tax adjustment. Miles now has about $243,000 more than Noah. And here's the uncomfortable part. Noah worked harder for the lower result. He read more, he watched more, he reacted faster, he made more decisions. But the market does not pay an investor based on the difficulty of the strategy. It does not measure hours. It does not reward stress. It does not care how complicated your system looks. It only multiplies the capital that remains invested. If this comparison is changing how you think about investing, hit the like button and subscribe, because we break down financial decisions using the numbers people usually leave out. Not to make money look easy, but to make the trade-offs impossible to ignore. By year 25, each man has personally invested $360,000. Noah has approximately $617,000. Cameron has approximately $832,000. Miles has passed $1.1 million after the hypothetical tax adjustment. Miles is almost $490,000 ahead of Noah. $500,000 is not disappearing because of one catastrophic decision. It is disappearing because Noah's return is slightly lower every year. That sounds harmless, but a small annual difference repeated over a long period does not remain small. The lost return also loses its future return, and that future return loses its future return. The gap starts compounding against Noah. 30 years have passed. All three men are now 61. Each contributed exactly $432,000. Noah, the day trader, finishes with approximately $833,000. Cameron, the swing trader, finishes with around $1.21 million. Miles, the index investor, finishes with roughly $1.75 million after the simplified federal capital gains adjustment. Miles ends with approximately $916,000 more than Noah. He also finishes more than $543,000 ahead of Cameron. Same salary, same monthly investment, same 30-year timeline. The difference was not how much money they contributed. The difference was how much of each return survived long enough to compound. And remember, Noah didn't go broke in this model. He earned a positive return. We gave him a far better ending than many real traders experienced. He still finished nearly $1 million behind.
So far, we have only measured money. Now we need to measure time. Suppose Noah spends an average of 750 hours a year preparing, trading, reviewing trades, reading news, and studying new systems. That is about 14 hours a week. Over 30 years, Noah spends 22,500 hours. A traditional full-time working year is roughly 2,000 hours. Noah has effectively worked more than 11 additional full-time years. Cameron spends less. Suppose he averages 200 hours a year managing positions and researching opportunities. Over 30 years, that is 6,000 hours, about 3 full-time working years. Miles spends 2 hours a year reviewing the account, checking his contribution, and making sure the plan still matches his goals. Over 30 years, that is 60 hours, less than 2 normal working weeks. Noah spent more than 22,000 additional hours and finished with almost $916,000 less. We cannot automatically say those hours were wasted. Maybe Noah enjoyed trading. Maybe it challenged him. Maybe it gave him a community.
Maybe he developed valuable skills. But those benefits should be described honestly. They are the benefits of a demanding hobby or profession. They are not proof that the strategy built more wealth. And if Noah values his time at only $30 an hour, those 22,500 hours represent $675,000 of potential time value. That is not included in the portfolio comparison. Does this mean nobody should trade? No. It means trading and long-term wealth building should not automatically be treated as the same activity. Someone may trade because they enjoy competition. Someone may trade because they have tested a real strategy. Someone may trade professionally with specialized technology, information, and risk controls. Someone may simply find markets fascinating. The mistake is not making a trade. The mistake is risking your entire financial future on the assumption that interest automatically becomes skill. Watching financial content does not create an edge. Understanding chart patterns does not guarantee an edge. Having 3 profitable months does not prove an edge. An edge must survive different market environments. It must survive costs. It must survive taxes. It must survive mistakes, and it must beat the passive alternative after accounting for the time required. That is a much higher standard than being profitable this week. Here is the approach that protects the future without pretending the desire to trade does not exist. First, build the core of your wealth with diversified, low-cost investments. For many people, that means broad index funds purchased automatically over long periods. This is the money connected to retirement, financial independence, and major life goals. It should not depend on predicting next week. Second, separate entertainment money from future money. If you genuinely want to trade, create a small, clearly defined trading account. Maybe it represents 5% of your investable portfolio. The exact percentage depends on your financial position and risk tolerance, but it should be an amount that can fall dramatically without changing your retirement date. No margin, no borrowed money, no raiding the emergency fund, no increasing the account because of one lucky month. The purpose of the wall is simple. A bad trading period should not be allowed to infect the part of your portfolio responsible for your future. Third, use the correct benchmark. Do not compare your account with the amount you deposited. Do not compare it with your worst month, and definitely don't compare it with another trader's screenshot. Compare your after-tax return with the return of a relevant low-cost index fund during the same period. Then subtract every cost: data, subscriptions, spreads, borrowing costs, taxes, and the value of your time. Only then do you know whether the activity is creating value. Fourth, automate the part that matters most. Your wealth-building system should continue functioning when you are busy, when you are afraid, when the market is falling, when financial news becomes dramatic, and when you lose interest in finance for 6 months.
A strategy that requires perfect motivation for 30 years is not a strong strategy. It is a fragile promise. Automation removes the need to make the same good decision hundreds of times. Noah's mistake was not that he worked hard. Hard work is valuable. His mistake was assuming that more effort must create a better investment result. Cameron's mistake was not that swing trading looked more reasonable. It was assuming that a calmer form of market timing removed the difficulty of market timing. Miles did not win because he knew more about tomorrow. He won because he stopped making tomorrow's prediction a requirement. He accepted that some years would be bad. He accepted that he would never buy at the perfect bottom. He accepted that someone else would always have a more exciting return this month. And in exchange, he received something far more powerful: consistency. The market does not send a trophy to the person who watched it most closely. For most ordinary investors, it rewards the person who kept buying, stayed diversified, controlled costs, and gave compounding enough time to become powerful. Activity can feel like progress, but they are not the same thing. Sometimes the most expensive investment decision is the decision to keep making decisions. So which one are you right now? Noah, the day trader? Cameron, the swing trader?
or Miles, the index investor? Tell me in the comments, and be honest. If this video helped you see the full cost of trading differently, subscribe to the channel and hit the like button. Because your future is not built by the strategy that creates the best screenshot. It is built by the strategy you can survive for decades. But there is another question. What if Miles had not bought the entire market? What if he had invested that same $1,200 every month into one exceptional company and held it for 30 years? Would concentration have made him dramatically richer? Or could one bad choice have destroyed the entire plan? That is the real math we are running next.